Hi, I'm Jason Sen. Thanks for joining me today. The question that I am asked the most by my subscribers and those who are getting into trading, it definitely is, how do you trade a breakout? And it is a difficult one. I must admit, I try and avoid breakout trades when I can. Buying on a dip into a support level in a bull trend is pretty simple. You just put your buy order in, you put your stop order in, you wait for the market to come down and hopefully hit your entry point, and that's it. Either you get stopped out or the market goes up and it hits your target. Same with the selling into a resistance level in a bear trend. You put your offer price in, you put your stop loss just above wherever it needs to be. You hope that the market rises. You don't even have to be in front of the screen. Hits the resistance level, your order gets executed, and then hopefully the market turns around and heads towards your profit target. Very simple. Trading a breakout is certainly more difficult. You have to be a lot more active. You have to be monitoring the trade when you do it, really. But it's something that is important to try to learn or try to get to grips with and figure out what works for you, because markets do break out. So, for example, this is clearly a bear trend punctuated with bear flags or consolidation patterns. And unless you're ready to actually sell the breakout, you won't be able to capitalize on the move to the downside. As you can see, breakouts can be very swift, and so if you can trade these and you can get on the right trade, then it can be very profitable indeed. You do get false breaks, like this example here. Market did rocket up. We didn't go too far though, and unless you'd got out of your long position here and taken a profit, then we sank back very quickly, back below the trend line. So it could have turned into a losing position very quickly. Anyway, so probably I could say that no two breakout is exactly the same, but I've got three ideas for you on how you could trade a breakout. Okay, so here I've zoomed into the 30-minute chart, so we can just take one of those examples. I've taken the one with the false break as well, and we'll try and come up with some ideas. So the market's in a bear trend, we know that already. We're clearly establishing a sideways consolidation, and we use our trend lines to see that. Probably a bear flag, but we don't know for sure. The market could break higher. So this first trend line works. We draw the two consecutive highs. It's tested for a third time. On the fourth time, it breaks. Now, I'm not going to run into what we could have done in this point. I'm really just showing you that there is no foolproof method. If you'd managed to jump into a long position on the break above here, as I say, you'd had to have taken your profit very quickly, and it really would have only offered 30 pips. I would have thought that the market would have traveled a lot further, in fact, and of course I would have been wrong. The market turned around and collapsed back into the range. Okay, so we have to accept that not every trade goes well, and this would have been one of those examples. Now, having failed on the breakout to the top side, we're wondering, will it break out to the downside? We've got our trend line joining the two consecutive lows. It's caught the trend line has caught two of the dips so far, so we're wondering, when will it, if it's going to break, or when will it break? Now, the market does break lower eventually, and this is where I'm going to zoom in and give you a couple of three ideas onto how you could trade a breakout. Right, zoom right in on this trend line here. Now, in this case, the only really trade that would have worked is if you're actually watching the market break lower. Maybe you see this candle where we actually close. It's a 30-minute candle. It could be a 30-minute or a one hour candle, whatever you're looking at. Now here the 30-minute candle closes below the trend line. We have a little bounce back to the trend line, and it's only then that the market collapses. So it probably spends about an hour and a half dithering just below the trend line. Okay, so people say to me, should I wait for a candle close below the trend line? That's a perfectly adequate indicator. You could use a 30-minute candle or a 1 hour candle. Probably using any longer than that, 4 hour candle, you're probably risking actually missing the trade too much. In this case, perfect example, if once it broke, 30-minute candles closed below the trend line, I'm going to sell into a short position with a stop just fractionally above the trend line. Probably above this peak would have been just right. I'm looking at silver here, so that would have been just above 23.65. If I was selling at around 23.50, that represents maybe a 20 pip stop loss. Very small. You do have to keep them pretty small, these breakout trades, because once we get back in through the range, you don't want to be running the short position too far. So that's the first thing you could do. The second idea that I could give to you is to use, so that you don't have to sit and monitor the trade, is to use a stop to enter order. Now, not everybody knows about these. A stop loss order you probably are familiar with. When you buy into a position, you will have a sell stop order, which is a sell stop loss order. So if the market goes down to a certain price where you know that you need to exit the position, the order will automatically take you out of the position by selling on a stop loss basis. Now, the other thing you can do is you can put in a stop to enter order. In this case, it would be a sell stop to enter order. So when the market dips to a price that you decide at which you want to enter because you believe that at this price we definitely would have broken below the trend line, you will automatically be entered into a sell order as the market drops to the price. So it's called a sell stop to enter. Now you could have that, I don't know, let's say at 23.50, market hits 23.50. You could then put your stop in at 23.70, and you would then hope that the market stays below 23.70, and then the market goes down, and you could have a target in that order as well. In this case, a target would have been fantastic if it had been at, say, 23.00. You would have made 50 pips, risking 20 pips, which you're going to do those trades every time, aren't you? Risk 2 to make 5. That is a fabulous risk reward. If all trades could work out like that, we would certainly be happy traders, wouldn't we? So that's the second thing you can do, a stop to enter order. When you do that, you also should put a stop loss order in, just in case it does go wrong. The other thing you can look to do, and I probably want to do some drawing here, would be to wait for the bounce. Now, this would not have worked in this case, but just let's say, for example, the market had dropped to here and then bounced. Now, this does often happen. The break point will break, will go down a little bit, the market will retrace, it will retest what is now resistance. I'll put an R there. Okay, this is support, or it was support, it had been in the past. We don't eventually, you know, obviously support doesn't last forever. If it's tested enough times, there's a good chance it will break lower. We just don't know whether it'll be the third, fourth, fifth, or sixth test, or whatever it might be. Anyway, right, the market breaks support. Once we've broken support, support becomes resistance. This is now the resistance line, this trend line. So if it's broken and you haven't been quick enough to get on the trade, you can sit back and wait and just hope that the market retraces back to the resistance line, and then you can try to enter a sell order, and you could have a stop loss. Well, in this case, I would have my stop loss above what is the 200 period moving average for the 30-minute chart. Now that is somewhere around just below 23.70. So if we had the stop in at 23.70, as the example I've used before, you'd feel quite safe. You'd think, well, if it goes back above the 200 period moving average on the 30-minute chart, I want to be out anyway because the market's probably going to rock it. But I'm prepared to sell at what should be now a resistance level in the hope that we drop down here. And of course, eventually we did anyway. So if that had happened, that would also be a nice strategy. If you miss getting in just on the break, you don't want to be selling here really. Problem is, if you sell here, you've still got to have your stop loss up here. So your stop loss could be as much as 60 pips. Now, all right, if you think that you've got maybe 80, 90, 100 pips or more potential profit, then it could be worth doing the trade still, but I feel uncomfortable with that. I like to have my stops tight, as you will know if you follow me. And this would be too much for me. Now, of course, you can use a combination of all three. So, for example, let's say you wanted to sell 3 contracts. That's your normal trade size. You could have a stop to enter order, stop sell to enter order here, maybe, and then you're ready. You're in on one contract, perhaps. You would sell one contract there on your stop to enter order. You could then think, right, I'm not going to go too mad, because if the market then dips and then bounces, I could enter another order here. That could be my second point of entry. And then you're scaling into the position gradually without having too much risk on right at the beginning. The third idea would be to wait for the candle close below. So who knows? Let's say the market rocketed down. The candle didn't close. We bounced back. You've got 2 positions on. and you're like, okay, well, we did break below the trend line, but it's all happened so fast that we haven't actually had a candle close below. And then maybe over here, you get that candle close below, you get a solid red candle, and then this could be your entry point here, your third entry point, where you decide, well, I've now got the candle close as well below the break point, below the trend line, so I'm going to enter the last part of my position, and then hopefully the market will collapse as it did here, bang, and then you hit your target. So there's 3 different ideas. You can use a combination of 1, 2, or 3 of those ideas. That's the best suggestions I can give you for a breakout. I hope that's helpful. Please do like, please do subscribe, please do share this for me. You would do me a great favor, and do put comments in the box, and I'll do my best to answer any questions and get back to you. Thanks very much for joining me today.